Monthly payment versus purchase price. Which one is better? And do you know why? Look, every smooth-talking, slick car salesman will happily convince you that your $200 monthly payment is no big deal. Just don't pay attention to the fact that you got a 25% interest rate, you're going to be making payments for 8 years and end up paying, 3 times the value of the car, all while the value of the car continues to go down. Look, I think we can all agree that is no bueno. But is there a difference when it comes to investing in real estate or buying a home? That's what we're going to discuss in today's video. But before we get started, guys, for all the effort and time and hard work that I put into creating great and transparent content for you, it would really mean a lot to me if you would like the video and leave a comment down below letting me know if you enjoyed today's discussion. Now, to properly analyze this topic, I want you to think about buying a home as if you were a real estate investor. And I know you may have zero interest in ever investing in real estate, but go with me here for a couple of minutes as I contrast monthly payment versus purchase price. Leading up to the Great Recession in 2007 and 2008, many investors were hoping to buy real estate with the goal of it going up in value or appreciating quickly, and then selling it for a huge profit 1 to 2 years after purchase. Now, the banks, lenders, real estate agents, and talking heads in the media at the time all agreed that real estate was all but guaranteed to go up. Well, this belief that real estate could never and would never crash caused people to take out riskier and riskier loans, or more specifically, subprime mortgages. But 2 years later, your adjustable rate loan starts having major problems. Now, when it was time for the debt to reset at a higher rate, but the home values had not gone up, and instead declined, investors, again I use that term ironically, were unable to refinance to a better fixed rate mortgage. This turbo-screwed the owner, doubling his payment, pushing him into foreclosure, annihilating the housing market, and crushing the overall economy. So what did we learn? Investing for appreciation is risky. It's not guaranteed. And in many cases, it was downright irresponsible and closer to gambling than investing. All right, Mike, but if we shouldn't invest for appreciation, what should we invest for? Now, that's a great question, class. Now, there were investors who made it through the Great Recession unscathed or even came out on the other side significantly better than prior to it. But how? How did they weather the greatest financial meltdown and real estate crash of the last 80 years? Answer: cash flow. Rather than hope the property would appreciate in value over the short term and then sell it for a higher dollar amount than when they purchased it, they approached the equation from a long-term perspective. What if I got paid a profit every month to own this property regardless of what the value of the property is? Now, if the value goes up, down, or sideways, so long as I keep bringing in cash flow, I can wait as long as I need for the market to recover. Now, I'll use a real-life example from one of my rentals to illustrate this point right now. I bought this 3-bed, 1-bath house in 2020 for $60,000 in Gary, Indiana. Now, my monthly payment on this property, including principal, interest, taxes, and insurance, is $350 a month. It initially rented for $900 a month, but it's currently rented for $1,250 a month only 3 years later. Now, because my full-time job is as a police officer, I always encourage everyone to check my math. But it seems as though I have a $900 spread each month. Now, it's not all profit. I have to set aside money for vacancies, maintenance, and paying a property manager. But at this point, my true profit on this unit is about $475 a month, or $5,700 a year. Now, so long as this house is occupied, I can make my $475 a month like clockwork, no questions asked, every month, forever. Now, the intelligent viewer is probably saying, but what if rents drop, Mike? Again, that's a great question, class. That's where we jump into the historical data. Now, I did a full 15-minute video breaking down the rental rates nationwide over the last 115 years, and it can be found right here, but I'll summarize it quickly today. In the last 115 years, over any 5-year period of time, rental rates have never been down. Year to year, there's small increases or decreases, but they always correct upwards very quickly. Even during the Great Recession, rental rates as a nationwide average dropped by around 1 to 2%, and then quickly pushed higher. Now, here's the only caveat. In high-end luxury markets, very expensive areas like Manhattan. And in large apartment complexes, there is usually more instability in rental rates during an economic downturn. We're actually experiencing this right now. Single-family rental rates right now are still increasing, but large apartments and Class A luxury rentals are taking a hit. That's why I don't encourage people to invest in those asset classes. But to each their own. It's a free country. You can do whatever you want. Okay, back to math class. Let's say my $1,250 a month in rent takes a 2% hit. You know what? Actually, let's say it takes a 20% hit. 10 times worse than the Great Recession. That means that my $1,250 a month becomes $1,000 a month in rent, which is still a $650 spread when you factor in my payment that's fixed at $350 a month. And I'm showing a profit still of $225 monthly. So by planning for 10 times worse than the worst decline in rents ever, I am well insulated against a potential crash. Now let's bring it back to monthly payment versus purchase price. If you can agree with me that investing for cash flow is smarter than investing for appreciation, well, next we got to decide how best to maximize cash flow. And that's by minimizing your monthly payment. Easy. It essentially boils down to rent minus expenses equals your cash flow. The largest expense you have is your monthly payment on the house. Now, we can't really change the cost of property taxes or insurance. Yeah, you get quoted the best rate for insurance that you can, but at the end of the day, it is what it is. Your taxes and insurance will always increase a little bit year after year. It's one of the factors that drives rent increases. But you can lower your monthly amount due in principal and interest on the loan. The most well-known way to change that monthly payment is by changing the purchase price. But the lesser known variable you can adjust is the interest rate. Now you might be saying, I don't get to pick my rate, Mike. The Fed sets rates, lenders sets rates, not me. Well, you're mostly right. That's mostly true. Now, excluding seller financing and owner carry options, there are still ways that you can get your rate down if using traditional lending. Now, let's say the seller was going to give you some money, either a reduction of $10,000 in price or a credit of $10,000 towards buying your rate down. Which one would you choose? Do you know? Let's do some quick math. Let's say you're buying a $500,000 house with a 6% interest rate, the unfortunate average right now. You have a payment of $2,998. Now let's take the $10,000 and deduct it from the price, so we see what a $490,000 house with a 6% interest rate is. You now have a payment of $2,938. That's $50 a month saved. That's not bad. But last, let's take that $10,000 and apply it towards buying the rate down from a 6% to a 5%. That $500,000 house now has a payment of $2,684 a month. That's $314 a month saved, or $264 more dollars saved than by just dropping the purchase price of the property. But what if the seller isn't offering credits or cash? Well, you can always pay more upfront out of your own pocket to buy your own rate down, and many people do. I understand that you may not have as much money as you would like, but rather than put more money down, consider buying the rate down. Side note, don't do temporary rate buy downs. You only buy the rate down if you're buying it down for the life of the loan. You don't want to be adjusting upwards down the line and bumping your payment back up again. We've run that experiment before. Don't do it. Now, unlike when buying a car and playing with the monthly payment, you aren't just adding extra years on the back end of the loan. All of these examples still have the same 30-year time frame. So holding constant for time, the best way to decide whether or not one option is better than another is by deciding which option leaves more money in your pockets via a lower monthly payment. And as an investor, the lower that monthly payment is, the higher my cash flow profit is. Now, I think it's pretty easy to understand why investors are willing to overpay at times for a property if they get the terms that give them a lower monthly payment or less money out of pocket. It's all about maximizing that monthly cash flow and therefore maximizing your monthly profit. But what about non-investors? What about homeowners? The homeowner doesn't want to make monthly money on his property. He doesn't want to invest in real estate. He doesn't want to be a landlord. And yeah, a monthly payment sounds great, but he doesn't want to overpay for a house and then end up underwater because the market turns. These are all extremely valid concerns and very good points to make. Now, first, let me start by saying it may not be a good idea for you to buy real estate right now. I'm not going to lie to you. I'm not going to say real estate always goes up and it's always a great time to buy. It isn't. If you think you're going to move in the next couple of years, if you're worried you could be fired at your company, or maybe your company might downsize, it might not be a good time to buy. Now, if there are already things that are causing uncertainty in your future, I would hold off on buying a house. Second, the truth is that unplanned emergencies, or things like getting fired, can happen in an up or a down market. You could close on a home tomorrow. Your mom could have a medical emergency the next day, and this causes you to have to move across the country and take care of her. It happens. Now, even if the market is appreciating and we were in a seller's market, just the cost to conduct a real estate transaction can still put you in a position where you're technically underwater. I mean, it costs 6% just to pay the real estate agents. So if you bought a house and it hasn't appreciated yet, even in an up market, even buying after a crash, you could still end up selling at a loss if you were forced to sell at the wrong time. There's always going to be a modicum of risk associated with any purchase. You never know what the future holds. So here's my advice to the homeowner who's hoping for a crash so that they don't overpay. Maybe a crash comes. Maybe it's in 3 months. Maybe it's in 3 years. Maybe it doesn't crash. Maybe it does. But we definitely know that right now you are wasting time and money by renting. Even if you purchase a house, even if the market crashes 20% and you're now underwater on your house and therefore you can't sell without losing a substantial amount of money, just keep making your monthly payment until the market recovers. Even the worst markets recovered after the 2007-2008 collapse within about 8 years, and the worst of the worst markets were recovered by 2021. So worst case scenario, you're looking at 13 years to recovery. But what if you lose your job and you're forced to become a seller and you sell at a loss to try to avoid foreclosure? Look, I get it. That is the absolute worst case scenario. But what if you had a backup plan or a contingency that could defend against that type of risk? What if you just rented the property out instead of selling? Now, you have to move to take care of mom. You don't want to sell at a loss. Rent the property out. Cover the mortgage that way. Now, I understand you don't want to be an investor. But which option is the lesser evil? Becoming a forced seller or becoming a forced investor? And I get it, if landlord is too gaudy of a term to call yourself, then just, call yourself land bro or whatever, whatever makes you feel good about yourself. I've already shown you the math on how you can weather nearly any economic turmoil by converting to a rental property and just cash flowing until the market recovers. And then you sell if you don't want to be an investor. Now, the only problem, of course, is if you bought a house that makes for a terrible rental property. Big, beautiful, new build houses that sell for $800,000. They've got a $4,500 mortgage payment, but they're only going to rent for $3,000 a month. Those are terrible rental properties. You would end up losing money every month if you turned it into a rental. So if you're going to buy something that doubles not only as your home, but could also be transitioned to a cash flowing rental property in the event of an untimely crash in the market. And if you say, but Mike, I want that big, beautiful, new build home. Well, great, but there's risks associated with it. You can't have everything. No matter what, there's always going to be some risk involved. So plan for what you can. Don't bank on appreciation. Cash flow is much safer and smarter. And monthly payment ends up being much more important than purchase price over the long term, in my opinion. Now, here's a couple of red flags to watch out for when investing based off cash flow and monthly payment. If a property you want to purchase will not cash flow day one, but your projections show that in a few years with rent increases, it'll work later, don't do it. This is just as dumb as investing for appreciation. You're hoping rental rates will appreciate. They might not. They might stagnate. They might drop. The deal either cash flows today or it doesn't. If you hope for rent increases to make a deal work, you're going to get what you deserve, and most likely you're going to feel some serious pain. A lot of syndicators working in large apartment units are feeling that pain right now. Don't be them. Guys, thanks for sticking with me on this video. If you aren't convinced, that's fine. I don't want you or anyone else to ever make a decision that you aren't comfortable with. We all have our own levels of tolerance for risk, and at the end of the day, you need to be able to sleep at night. I want you to be able to sleep at night. I just want you to be able to sleep at night in a house that you own. And I've tried to show you some ways to think about it that might hopefully help you become a homeowner. Now, if you're interested in helping me out, please like the video, leave a comment down below. Let me know if you're currently renting or you own. I'm just curious to know where the audience is at on their journey right now. I appreciate you guys, as always, for watching. Thanks for being here, and we'll catch you next time.